This is a lot that's come out of the letter and publications over the last several weeks. So the title, Year of the Rabbit to the Dragon. Okay, the overview is we'll talk a little bit about the letter and what we did in the rabbit year, what the commodities and the markets did, and then we'll talk about some thematics, like the idea about gold leverage, why it didn't happen in 2023, and then the financing risk that everybody outside complains about, some who have wandered in here as well. And then 2024 thematics. I mean, these will change, but I thought I'd grab a few, and then I'll be out of here, and then we'll start going through the talks. Okay, let's get going. Okay, so the year of the rabbit, we kicked off on issue 700. We finished at 748, 48 publications of the weekly letter. For anybody that's not a subscriber, we digest major themes. Then we talk about our portfolio. We do the occasional rant, or I do the occasional rant. And that's where a lot of these talks come from, is those deep dives into either companies or themes. Then Stock Talk, we break down companies' news flow. We don't try to resurrect it, repeat it. We just want to see what the impact is on, do we keep this share, this position, or do we sell it? And then we compile all our interviews and site visits and conferences that me or Brent do. And so site visits and conferences, this was actually my picture. I took this picture. That was not the camel I rode, unfortunately, but he was sitting in the right spot. So most of my travels, and I do a lot of site visits, I do almost one a month, and then usually there's way too many conferences. Nothing against this one. Most of it was in the Western Hemisphere this year, last year, except for one outstanding trip to South Africa for Indaba and to go to Egypt. Just so you know, in terms of the site visits, if people have been on or haven't been on, for me personally, you have to do them. I have to do them for me to get comfortable with the company and the asset. And usually I do them on my own, but occasionally there might be a group of other analysts on it, which is nice because, other people sometimes have other questions you hadn't thought of. But also the dinner chats at these visits are quite revealing because people talk about the latest rumors, which always helps in terms of what we do in terms of the letter. That's just a great picture. I could just leave it up there. Anyway, so this was the year of the rabbit. Which Elmer Fudd got the better of the rabbit last year. So China's demand for commodities appears to have been satiated, and that's what hit industrial metals, like copper and that. A strong U.S. dollar weighed on everything because the real rates were going up. So the Dixie, it peaked, but now the question is, has it peaked in 2023, and is it declining into 2024? The commodities that did the worst, lithium carbonate equivalent, LCE, down 80%. Nickel, with all the production coming out of Indonesia, down 44%. Palladium, despite the issues with Russia, that palladium is still coming out. But the problem is the market has really skipped hybrids, where palladium is used in these more intensely in the catalytic converters for hybrid vehicles. But M&A basically helped the base metal equity index outperform the majority of the base metals. And the other issue is that the broad equity markets did fine by their own. So why put money into a high-risk junior or a high-risk resource sector when I could make 20 to 40% in the broad equity markets, which are obviously infinitely more liquid? Only uranium was just out. That went up 86%. But uranium equities, even though they were the best performing equity ETF, they didn't provide that much leverage. They were up, but they were up by about half. Bitcoin rebounded because of the the equity ETF that was going around Bitcoin. But as soon as that equity ETF came out, Bitcoin went down. It's another one of those buy the rumor, sell the fact. Gold equities were positive by the end, as the GXJ points out, but they underperformed gold. So that's the year in a nutshell. So China's property slump is what drove a lot of what was happening in China and the demand for metals. So at the outset of 2023, I was bullish on China coming back because of the lifting of COVID-19 restrictions. That happened for about a quarter. And then the higher interest rates, property failures, then we had a real estate crisis basically, and that basically hurt all industrial metals. What we're looking for in 2024 is hopefully any kind of stimulus by the People's Bank of China that might help make the economy, improve the economy. And I'll give you some numbers on their GDP growth in 2023 versus 2024. And so what we had, an issue at Exploration Insights, the portfolio, is, yeah, that rabbit did have some teeth. So our portfolio, the companies we held, went down about 15 to 20%. The ones that did well was a US-based uranium play. Like I said, the uranium did well. Top pick royalty generator did well because it was cash flowing, didn't need to go to the market. Quebec-focused prospect generator, who's just to my left, did okay. And then an exploration copper explorer in Australia and a copper producer in Brazil. The biggest underperformers, partially because of results, but also because of the overlying or underlying financing risk, were grassroots explorers. And so the thematic for me at the end was bang for buck in terms of exploration. So if I have to invest in a company that needs $1,000 per meter to drill, that's 1,000, 1,500 meter program versus a 5 to 10,000 meter program. So then I was moving away from projects that were too remote, when they would need capital sooner and they would need to raise more in a fragile market. So overall, from inception of the positions there, the portfolio right now sits at about negative 9% at the end of the year. So this is the myth of leverage. So what's been happening in Q4 towards the latter part, we've been getting phone calls, new subscribers saying, I'm absolutely, into the resource sector. I've made my money on the NASDAQ or wherever I've made it. Now I think the resource sector is undercapitalized, so I want to be in it. And I was saying, well, this guy was out of Boston or somewhere, and I thought, well, how much money do you have to spend? How much could you put into the sector? And he goes, 200 to 300 million. And I thought, wow, that's interesting. Where did you come from? So there may be these people out there that may enter in 2024 if the stars align. There might be a push. And so those are the people that might enter. Also, I took a call yesterday from Singapore from a family fund that were saying the exact same things. And they wanted to know, what are the levered stocks that I should invest in? Unfortunately, some of these funds, when they say small cap, they mean $1 billion. They don't mean 100 million or 20 or 2. So what I will show you in the next few slides, the rationale behind this. So here you could see leverage, gold price up, GDX spikes. Gold price down, GDX falls. Very attenuated, levered. But then here, not much. And so if we look at this, one reason for it is the central banks. So the central banks help support gold in a time of rising real rates. So the gold price was actually up 13%. Remarkable resilience that nobody would have predicted in a rising real rate environment. Central banks drove that. Okay, so they offset all the withdrawals. All these are withdrawals from gold equity ETFs. They were withdrawing all the way to Q3. We're hoping it was flat in Q4, and there might have been some pickup. Central bank demand was 800 tons over the first 3 quarters of 2023, according to the World Gold Council, 14% more than the previous year over the same period. Gold ETFs, the outflows, not inflows, the outflows were 9 times more than they were the year before. So the other problem with leverage is this diagram produced by a friend of mine, Ron Stewart, who's now working, I believe, for Leeds Cable. So he produced this graphic, nice graphic about Q1 19 to Q3 23. About the red line is the gold price quarterly, and then the black line is the all-in sustaining cost. So you could see that the gold price is going up, but so is the all-in sustaining cost. And then what we have is the margin basically declining. It peaked around 46%, 48%, but it's now waffling around 35%. And that's the leverage that was not provided. Okay? And here's an example. I mean, I'm just using Newmont because it's easier to get data. So what they did was they had a gold price, a reserve price of $1,200. That line should be here. And then you could see there's a couple of quarters where their all-in sustaining cost for the quarter actually exceeds their reserve price. And then when gold price started hitting 1,900, 2,000, they decided to lift their reserve price. But what it did was also lift their cost profile because they were bringing in lower grade, higher tonnage, which means more cost. And so that was some of what was driving the negative leverage. And as you could see, over this period, which would be about 8 quarters, like there's about 2 or 3 times that they exceeded the all-in sustaining costs. Here they've exceeded it 2 out of 3 times already in 2023. Okay, and we saw this. I saw this in Pan American back in 2021. So 2021, they had decent margins of 40%. But then during COVID, their margins shrank down to almost 20%. Now they've been sitting at about 30. So I sold out of this back then because I was worried about these margin compressions. At that time, it was mostly because of COVID. Now it's because all their costs have actually gone up. Oops. Okay, so here's another thing, is this reality check on reserves. So that's the other supposed leverage that a gold company provides. So back in 2021, gold, their reserve price, Newmont's reserve price, and I'm not picking on Newmont, I'm sure I could find this otherwise in other people's, but their reserves were 92.8 million ounces. Okay, that's the light blue line right here. Okay, that was their declared reserves at the end of 2021. But they also every year show sensitivities to gold price. So the person doing all this would say, okay, I'll change the gold price without changing anything else. And say, okay, look at how many more ounces I can grow my reserves by 13% without doing anything but changing the gold price. You know, I've got now 105 million ounces as opposed to 92.8. You know, at the end of 2021, if I change the gold price. But what actually happened is at the end of 2021. They did change their reserve price from $1,200 to $1,400, which is a $200 increase, the same $200 increase that they graphically showed us back in 2021. But their reserves, they only went up 4%, 3.3 million ounces. And interestingly, 3.1 out of the 3.3 is an acquisition. That 3.1. That was increasing their ownership of Yanacocha to 100% by buying out Sumitomo and Buenaventura. So really, they were flat. They increased their gold price $200 and they were flat. And the last thing any gold company ever wants to show is that they did not replete their reserves, that they're actually negative year on year. They just managed to get away with not being negative. So let's get into financing. So we talk about leverage, nobody's interested, but also, the ambience. One, gold demand by central banks does not spill over into gold equity ETFs. And so nobody cares about the resource sector because the banks just want to diversify their reserves. Whatever's in US dollars, make it gold. I don't want leverage to gold. I don't want to buy equity. So the gold ETFs, nobody was buying. And as I showed you, they were withdrawing. So there's no knock-on into equities. And so the sentiment is negative on equities and potentially negative on gold, but the demand is there because the central banks are buying. But they're buying for a different reason, just diversification. So the total number of financings was down, not hugely, 4%. Some of this is because of Australia over the TSX. The number of financings, more people wanted money and got less. In the gold sector specifically, which is a big part of what happens in Canada, where the money goes, you're down 17%. You're down almost $1 billion. Less money out there doing things or doing nothing. And then, basically the number of financing stayed the same. Base metals down not by the same amount, 7%, 3.9, 4.2 billion, but 30% more transactions. Some of it, maybe copper related, where people were maybe a little bit more, the sentiment was a bit better. But the big winner that made up for everything, and that's why the total amount of financings was only down 4% and not down by 15-20, was specialty commodities like lithium, rare earths, and other things. That was actually up 31%. So up to 3.2 billion. With almost 50% more transactions, so a lot more interest in the sector. And so if we ignore what's global, which was this graphic, that's global, TSX, Australian exchange, anywhere money is raised. This is just the TSX Venture, So this is not only resource metals, it's also oil and gas. But it's not a bad barometer. So if you look at the TSX Venture, year on year, this gray line is 2023 IPOs. Dark line, 2023 IPOs, 2022 IPOs. Gray line here is financings, monthly financings. In 2022, dark line, 2023 financing. So what you see is 60% less IPOs, which is a good thing. We don't need more companies. The total amount raised was 27% less. That's why most of these people outside are depressed, because that's hitting them directly. So I might show you the global numbers, which don't look bad. This looks bad. Only the months of February and August actually were better than 2022. Every other month was worse. Again, the thematic is stronger demand for fewer funds. So what that translates into is that we just basically were flat in terms of exploration expenditures, 2023 versus 2022, 12.7 versus 13 billion. So you're wondering, well, how the hell did that happen? Well, the thing is, what happened was there was still $1 billion fall in global gold exploration, which is directly related to what we saw happening in the TSX Venture and the gold sentiment. And that's all rising real rates. That was offset by copper, more copper exploration, more lithium exploration, more nickel exploration. Major companies, so 45 to 50% of that total number is big companies that don't have the financing risk. They put more money in. Intermediates, interestingly, don't really move the needle. That's only 8 to 10% of the total. The juniors do move the needle. And when they're drop, that does move the needle for everybody. So they reduced their budgets by about 8%. 4.5%, sorry. But that would include Australia. And the ASX funding was easier, especially for lithium, rare earths, and a lot of other metals. Because a lot of what's happening in Quebec with the lithium is actually funded by Australia. Canada just caught on late. So that's why some companies have gone to Australia to look for funds, because the market at that time was more buoyant. So this graphic is all the major resource countries, mostly gold. The dark line is what was spent in that jurisdiction in 2023. The light blue line is the peak, the recent peak, which I believe was around 2012 for most countries. The squares are the proportion of the peak. So the ones that are up here did well versus their peak. The ones down here did not do well versus their peak. I've done the same graph when I was in Africa, and Africa, all the countries in Africa that were getting exploration funding were spending about 30% of their peak. So when there's less money, the high-risk jurisdictions, most of them get less money. More money gets focused in on the US, Australia. Canada's always going to get money because of flow-through. It's not asset quality. It's just money for a tax loss. But Australia is doing really well because of critical minerals. The US is doing really well because a lot of the US guys only want to invest in US assets now. Right. Okay, so all that translates into project activity. So changes in funds, capital markets, direct link to news flow, which a great proxy is drilling. 20 to 25% drop in reported drill holes from 2023 to 2022. 24% drop in the number of projects discussed. The gold project specifically fell by 35%. And this totally linked to the funding, the sentiment. Copper projects fell by 30%. So this forms a good basis for a turnaround, you know. Oh, wow, 2 minutes. So the year of the dragon. The dragon is the year of opportunities, apparently. The problem is we don't want it to end like this, because nobody liked the last episode of this program. So the issues, the themes that I'll bring up, real rates declining, global GDP decline. That doesn't sound positive. But my big reason to be bullish is more the supply side, something I could hang my hat on. Okay, so U.S. real interest rates, everybody's seen these dot plots. This is the rationale behind people phoning me up and saying, hey, I want more gold exposure. I think it's undercapitalized. I think equity is undervalued, blah, blah, blah. So here is a great graphic that you can get from these guys called macromind.me. You can go in there and they update it all the time. You don't have to produce this graphic. So this is the gold price in yellow, and this is real rates. So what we had was real rates peaking about November 23rd. The equity markets anticipated that. And so they were rising before. And so this is all about those people thinking, okay, this is peaked. I need to be in gold. How do I get leverage to gold? And, they're buying gold. Now they're talking about buying gold equity ETFs. But what's happened recently is the real rates have flattened, because nobody was really sure which way the Fed's going. Half the people think there's going to be 6 cuts, and other people saying there's going to be no cuts. So that's all that uncertainty that's making gold meander. And then on the other side, when we're talking about global commodities, is the GDP forecast. The global average GDP in 2023, 3.1%, is forecast to decline. What's driving the whole average positive is China and India. Everybody else, the US, Japan, Germany, France, is below the average. But this is what interests me in terms of commodities like copper, is this. So here you've got the major copper producer of the world, Codelco, state-owned Chilean producer. Only 5 out of the 30 years that they've been producing copper has been below this 1.4 million tons of copper per year. And that's when they were getting going. Now they're there, and their forecast. This is their forecast. This is not anybody else's forecast. And they need a lot more money, too. And then we add the other problem with First Quantum, whose mine, Cobre Panama, produced 1 to 1.5% of the total copper. The thing is, right now, those deficits that people were forecasting in 2025, they brought that forward to the latter part of 2024 because there's no copper concentrate. And so what's happening, if you watch this thing called the treatment charges, refining charges, what we call the TCRCs, they're actually going down. So that's what a smelter pays for concentrate. If the price is down, that means that there's no concentrate available. People are thinking that's going to go negative. The last time that went negative for me was when I worked as an analyst for Phelps Dodge in 2005 when Grasberg had a big failure. So that's interesting. First Quantum's in a lot of trouble. Now they have to start divesting assets because they've got, over $6 billion of debt, almost $7 billion of debt, $800 million that comes due like now. And even if they pay their debt, which they could with their working capital position or their cash position, they would be breaking all their covenants on the other $6 billion. So Las Cruces gets sold or the whole company gets sold. But that's going to delay a lot of things. And on uranium, which I said was, pointed out was the best performing commodity that I cover on a weekly basis. The push from that COP conference was to increase nuclear capacity. But the supply is the issue, is at risk. Before we had an overhang of inventory, we don't have that anymore. And now the problem with this, foreign entity of concern is now Chinese companies can't invest in Canadian juniors to build projects in Saskatchewan. Because if they're over 25%, you get it on the list. And they don't want your uranium, potentially. So now the M&A changes. And Cameco is going downstream. They don't seem to want to buy development companies. So this is a concern. And then Kazatomprom has already said that their production is not going to meet their expectations because they don't have enough sulfuric acid for their ISR operations. And one of the big mines that they want to produce, they want to build up, is basically how most of it's been sold to the Russians. So that uranium can't go to the States. Okay, summary conclusion. Year of the rabbit, weakness, Chinese economy hurt industrial commodities, but not as bad as you would have thought because people concerned about the supply chain issues and people buying producing assets and M&A. The central bank supported the gold price. So gold price was going up despite rising real rates when it should have been going down. So what happened to equities was that sentiment. Was nobody was buying gold equity ETFs. People were buying physical gold, but those people didn't care about equities. Leverage, that was bad in 2023. Could we see it improve in 2024? Yeah, absolutely. As long as they don't change the reserve price again. But those that didn't, they should be levered. So watch your leverage if you're looking at leverage. Don't look at these companies that are saying that, oh, you know what, I'm going to raise my gold price. And well, what's going to come in? Is it going to be a bunch of low-grade stuff that's going to, increase your all-in sustaining cost by 25%? Financing risk definitely escalated in 2024. And now the question is for everybody outside, will it get better? Uranium prices, obviously these people can raise money. Push for carbon neutral technology and supply constraints. Perfect little window. Year of the Dragon, the whole idea is that rates, real rates, you don't need the absolute rate to be positive, to be negative. You just need the direction to be down. Because it's flat now is why people are taking their foot off the gas with gold. They need that to go back down. Supply shortfalls, I really believe, will support copper, and uranium and other critical minerals will be impacted by these FEOC rules and will, continue to fragment the market. Okay, that's it for me. Thank you.